Just run me through your initial reaction to the sheer size of this bond offering. I mean, 5, 10, 20, and 30-year paper, which could bring in as much as $10 billion.
Yeah, good morning, Yousef. I would tell you that there's a very little surprise. I mean, we've had these jumbo deals from sovereigns in the region over the past couple of years. This is not a particularly, large departure. And you'll see by the end of the day, the demand will certainly be available for these types of transactions.
What about the pricing? What about the pricing? 80 bips over U.S. Treasuries for 5-year notes and 120 bips for the 10-year portion. Is that the kind of range that you would expect? Is it going to price tighter?
It'll probably come in a little bit, but yeah, I mean, they're not really providing much in the way of concessions relative to the Qatari sovereign. But yes, I mean, I think if the book builds, they could come in slightly. I mean, the valuations for a lot of the high-quality investment-grade issuers, are not cheap at the moment, but they're also not disconnected from improving realities. Certainly we find there's more value, I think, in high yield, which continue to be, even though they have improved in terms of pricing, they continue to be about 50% above the levels they were at in 2018 or 19.
So is this something you're recommending to clients, or would you say, keep what we have already on sort of the sovereign bits and pieces and increase a high yield because of the oil price support that's coming as a windfall? I mean, Brent currently sort of in the range of $75, $76 a barrel. I mean, GCC countries have a lot to celebrate.
Yeah, I mean, I think, everything we invest in, from banks that are well regulated and capitalized and profitable to, hydroponic farms that are tackling desert heat, world-class port operators, or governments that have done a very good job, I think, managing the public health issues with the virus or, the oil markets or even a complicated geopolitical environment. All of that is doing relatively well, but most importantly, as you mentioned, on an improving trajectory, with the reopening and higher oil prices. So, I would recommend that, your viewers buy everything from the region and not just the Qatar deal.
You had put in hedges in place for potential volatility and concerns around valuations early on in the year. What has happened to those hedges?
So we had hedges on U.S. rates, and those got taken out in April, principally on our, I think, belief that rates have really risen enough, and we think that they're going to be, more stable going forward. Credit, we have felt from the beginning, is really supported by the reopening and improving fundamentals. And so, we are certainly much more constructive on these markets over the next 6 months.
We also had news around EMAR, the bond, a 10-year Sukuk to yield 3.7%, $500 million issuance. Is that something that is worth picking up as well?
So that's come in considerably, right? It's priced in a lot tighter than initial price talks. But you could argue that there's, still some sense to it. I think it's important to highlight that, mobility numbers in the region are very encouraging, particularly in the UAE and Saudi. While other emerging markets, for example, continue to deal with extended lockdowns and very modest vaccination levels. So when you look at that, you look at the higher oil price, you look at just, a very solid, very, I think now credible, policy framework and structural reform initiative. There's not much not to like at the moment. So we think corporates like Amar, which are pretty high quality, are going to see their numbers improve as Dubai recovers. And so I think a lot of these corporate credits continue to make sense.
Dino, I'm just going to run a highlight from the interview that we had with Robert Königsberger. He's the CIO of Gramercy on the credit market. Let's take a quick listen.
Sure.
I think private credit in developed markets is getting tired. I think that it's very covenant light. There's leverage that's entering the system. It's very competitive in terms of the amount of capital. When I look at that in emerging markets, it's quite the opposite. It's lonely. You're able to get higher returns. You're able to get good collateral packages and good covenant packages. So I think that's the type of intelligent risk that I think one should take.
Private credit in developed markets is getting tired, talks about the emerging market gap. I mean, where is the opportunity for you then?
I mean, I couldn't agree more with that. This is exactly our experience in the private markets. We absolutely agree that you get much more return without necessarily taking much more risk. There's a massive funding gap for mid-market companies in the region. And that's why we are in the market now raising a fund in the private debt space, because we do think that private debt certainly offers a lot of opportunity, as do corporates in general in the region, which continues to have fairly steep credit curves. So you have, the Qatar Petroleums of the world and the sovereigns, access markets very efficiently, very cheaply. But corporates, especially, higher yielding or lower quality corporates, they definitely have to pay a significant premium in the region. And I think that offers value for investors.